In August of 2024, the S&P 500 dropped 6% in a matter of days. Japan's stock index, the Nikkei, fell over 12% in a single session, its worst day since 1987. The trigger wasn't an earnings miss. It wasn't a recession signal. It wasn't a geopolitical crisis. It was a rate hike. In Tokyo, by the Bank of Japan. A quarter-point increase in a country most American investors don't think about when they check their Fidelity app. And that quarter-point move sent shockwaves through every asset class on the planet, from tech stocks to mortgage-backed securities to emerging market currencies. That event was the first visible crack in a structure that had been quietly holding global markets together for 30 years. This video explains what that structure is, why it's breaking, and what it means for the portfolio built across this entire series. I'm Warren. 18 videos of building, the pyramid, the routine, the rules, the portfolio. Today is the first video about defending it, because the biggest threat to a long-term investor in 2026 doesn't start in Washington. It starts in Tokyo. And almost nobody in personal finance media is talking about it because the topic doesn't trend, doesn't fit in a headline, and requires more patience than most content allows for. The story begins in 1992, when Japan's asset bubble burst. Real estate collapsed, equities collapsed. The country entered what became known as the lost decades. Nearly 30 years of stagnant growth, near-zero inflation, and wages that barely moved. The Bank of Japan responded by cutting interest rates to zero, then below zero. Then in 2016, they introduced yield curve control, a policy that effectively capped long-term Japanese government bond yields at or near 0%. For 3 decades, Japan's borrowing costs were essentially frozen at the floor. That created a problem for Japanese investors. Pension funds, insurance companies, and banks managing trillions of yen in assets couldn't earn meaningful returns at home. Japanese government bonds paid effectively nothing, so they went shopping abroad. They bought US treasuries. They bought mortgage-backed securities. They bought European bonds. They bought anything that yielded more than zero. And because their borrowing costs at home were near zero, the math was simple. Borrow in yen at zero, convert to dollars, buy a US treasury yielding 4%, pocket the spread. That trade, borrowing in a low-rate currency to invest in a higher-rate asset, is called the yen carry trade. And at its peak, estimates placed its size at somewhere between $260 billion and over $1 trillion, depending on how broadly the definition is drawn. Japan became the world's largest foreign holder of US treasuries, holding over $1 trillion in American government debt. The country became, in effect, one of the most consistent and reliable buyers of the very bonds that determine long-term interest rates in the United States. If someone has ever wondered why mortgage rates in America stayed as low as they did for as long as they did, part of the answer is Japan. If you've wondered why the stock market rallied for years despite rising government debt and fiscal deficits, part of the answer is Japan. And if you've been watching mortgage rates refuse to fall even after the Fed started cutting, part of the answer is still Japan. The country doesn't appear in most personal finance discussions. It should, because the interest rate on your mortgage, the valuation of VTI in your Roth IRA, and the borrowing cost for every corporation whose stock sits in your portfolio are all influenced by how much capital flows from Tokyo into American bonds. Here's why this matters to the person watching this video with a Roth IRA and a split deposit running every 2 weeks. The Federal Reserve controls short-term interest rates, the overnight rate, the rate banks charge each other for one-day loans. But long-term rates, the 10-year Treasury yield, the 20-year, the 30-year, those are set by supply and demand. When demand for long-term treasuries is high, yields fall. When demand drops, yields rise. For 30 years, Japan was one of the largest, most price-insensitive sources of demand for those long-term bonds. Price-insensitive means they bought consistently, regardless of whether yields were high or low, because the carry trade math worked as long as Japanese rates stayed near zero. Mortgage rates in the United States are anchored to the 10-year Treasury yield. When the 10-year yield falls, mortgage rates tend to fall. When it rises, mortgage rates follow. The same applies to corporate borrowing costs, stock valuations, and virtually every asset class that's priced relative to long-term risk-free rates. For 3 decades, Japan's capital flowing into US treasuries helped keep that 10-year yield lower than it would have been without them. Not by a trivial amount, by enough to matter for every person with a mortgage, a portfolio, or a retirement account. In 2024, the Bank of Japan ended yield curve control and raised interest rates for the first time in 17 years. Then they raised them again. Japanese government bond yields, which had been pinned near zero for decades, started rising. The 10-year Japanese bond hit levels not seen in over 20 years. The 40-year Japanese bond crossed 4% for the first time since 2007. And the math that had made the carry trade work for 3 decades started to break. When Japanese yields rise, 2 things happen simultaneously. Borrowing in yen becomes more expensive, which makes the carry trade less profitable. And Japanese bonds start offering meaningful returns for the first time in a generation, which means Japanese investors have a reason to bring their capital home instead of sending it abroad. That process, capital flowing back to Japan from foreign markets, is called repatriation. And it's the mechanism through which a rate decision in Tokyo becomes a mortgage rate in Minneapolis, a stock valuation in New York, and a borrowing cost for a small business in Dallas. If Japan, the largest foreign holder of U.S. treasuries, reduces its purchases or begins selling, the supply of buyers for long-term American debt shrinks. And when the buyer pool shrinks, while the U.S. government continues issuing roughly $2 trillion in new debt per year to fund its deficit, the price of those bonds falls and the yield rises. That's supply and demand. The Fed can cut the federal funds rate all it wants. If the long end of the yield curve doesn't cooperate because foreign demand has weakened, mortgage rates don't magically return to 3%. Stock valuations don't automatically expand. Corporate credit doesn't suddenly loosen. The Fed controls the short end. Japan, and buyers like Japan, influence the long end. And the long end is what touches the life of every borrower, every investor, and every person with a retirement account. If you bought a house using the math from video 14, or plan to, the carry trade unwind is the reason the 30-year rate has stayed above 6% even as the Fed has cut short-term rates. The disconnect between what the Fed does and what your mortgage costs is not a glitch. It's a structural shift in who's buying long-term American debt. And until new buyers replace the demand Japan provided, that disconnect persists. Kai from video 14 ran the housing math at 6.25%. That rate wasn't random. It was the product of 30 years of Japanese capital flowing into US bonds, and that flow slowing down. For stock valuations, the mechanism is similar but less visible. When analysts value a company, they discount future cash flows using a rate anchored to long-term treasury yields. When those yields are low, the present value of future earnings is high, and stocks trade at generous multiples. When yields rise, the same future earnings are worth less today, and multiples compress. Anyone who's noticed that the market feels choppy even when earnings reports look fine, this is one reason. The earnings didn't change. The rate used to value them did. And that rate moved because the buyer who kept it low for 30 years started stepping back. Here's what this means in practice for the person who built the system across the last 18 videos. The VTI and VXUS portfolio from video 10 is a long-term hold. The 843 curve from video 15 doesn't change shape because Japanese bond yields rose. The snowball from video 16 still rolls. Compound interest still compounds. The architecture still works. But the environment around the architecture has shifted, and understanding the shift is the difference between staying invested through volatility and panicking at the wrong moment. If you've been following this series and building the system video by video, this is the moment where the system proves its value. Not during the good years, when the balance goes up and the quarterly statement feels rewarding. During the volatile years, when the balance drops 3% in a week because of something that happened at 3 a.m. in Tokyo. The system was designed for this. The diversification across domestic and international equities. The bond allocation for stability. The automatic contributions that buy more shares when prices are low. The emergency fund that prevents forced selling. Every component of the architecture built in videos 7 through 12 exists specifically so that the person doesn't need to react to events like the carry trade unwind. The reaction is already built into the system. The system reacts by continuing to function. If the yen carry trade continues to unwind gradually, as most analysts expect rather than in a single violent episode, the effect on long-term US yields will be a slow, persistent upward pressure. Mortgage rates may stay elevated for longer than the headlines suggest, even if the Fed cuts short-term rates multiple times. Stock valuations, which are priced using long-term yields as a discount rate, may compress slightly, meaning the same earnings produce a lower stock price. That's not a crash, it's a repricing. And a person holding a diversified index fund through a repricing doesn't lose money unless they sell. They experience a period where growth slows, the balance fluctuates more than usual, and the quarterly statement feels disappointing compared to the previous year. That feeling is temporary. The compounding is permanent. The rule from video 9 applies here more than in any other context. Never sell in a down market. The carry trade unwind is not a reason to sell. It's not a reason to move to cash. It's not a reason to time the market, shift to gold, buy crypto, or abandon the portfolio, the routine, or the pyramid. It's a reason to understand why mortgage rates aren't falling as fast as expected, why the Fed's rate cuts haven't loosened financial conditions as much as predicted, and why the stock market occasionally drops 5 or 6% on a Tuesday because of something that happened in Tokyo at 3 a.m. Understanding the cause removes the panic. And removing the panic is the entire point of this video. If you want to know whether the carry trade unwind is affecting your specific portfolio right now, there's a simple check. Look at the BND or bond allocation in the portfolio from video 10. If the bond portion has declined in value over the past year while yields have risen, that's the carry trade showing up in real numbers. The bond decline is the cost of the structural shift. The equity portion, VTI and VXUS, absorbs the repricing through lower multiples, but continues generating earnings. Over 5, 10, 20 years, earnings growth overwhelms multiple compression. That's the math. The math doesn't change because Japan changed its monetary policy. Every major market disruption in the last 30 years followed the same pattern. An invisible support structure weakened, volatility spiked, headlines screamed, and the person who held a diversified index fund portfolio through the disruption, who continued contributing, who followed the rules and didn't touch the allocation, came out the other side with more shares purchased at lower prices during the dip. The carry trade unwind is the same type of event on a longer timeline. Not a single crash, a structural shift that plays out over years. And the investor who understands the shift, names it, and continues investing through it is the investor who benefits from it in the end. The real threat in markets is never the loud one. The loud ones are priced in by the time the headline reaches a phone screen. The real threats are the structural shifts that happen slowly, in the background, in the bond market, in a country most people associate with anime and not with the interest rate on their mortgage. Japan's role in the global financial system is one of those shifts. It's happening now. It will continue. And the portfolio that was built to survive it is the same one this series has been constructing since video 7. Diversified, automated, low cost, and untouched. The wall around the architecture isn't a new product or a new strategy. It's understanding why the volatility is happening and choosing not to react. Next video, the 40s. The last realistic window for building meaningful wealth before the compound curve flattens and time stops being an ally. If the carry trade unwind is the external threat, time is the internal one, and time doesn't negotiate.